Welcome, ladies and gentlemen, to another edition of Capital Concepts. I'm Jeff Schuler. I am Director of Research at Spiker Consulting. You can get a hold of us by the website and phone number down at the bottom, or listen to me Monday through Friday, 8:30 to 9 a.m. on WSBR Radio, Money Talk Radio for South Florida. You can listen on the internet, WSBRradio.com, 8:30 to 9 a.m. Monday through Friday, Eastern Standard Time, or they do replay it from 7 to 7:30 at night on that link. Or you can go to our website, again, right down here, and we archive it. The new show gets up at about 11:30 every day. So you can not only listen to today's show, but you can go back and hear what I was saying before. One of those things where Jeff gets held accountable for every single thing he says. Now, today I want to talk about the reasons why we are owners of physical commodities. Why is it important? Why should you own it, aside from making money? Yes, making money is very important. And on a short-term basis, especially with palladium, you've seen we're doing quite well. Intermediate term, long term, we're going to do extremely well. And we have been doing very well. We will do extremely well with silver. Gold being our best hedge against declining values of the dollar. But that's really the point right there. Declining value of the dollar. Right now, we're starting to hear more and more and more about money coming into physical commodities like oil, specifically for a hedge against inflation, specifically for a way for mutual funds, institutions, large investors to protect the rest of their portfolios. It is a dynamic that has not existed before in the oil marketplace. What's going on is, before, you used to have supply and demand. How strong the economy was the only factor pushing oil up or down. But now you've got that added factor of buying coming in from institutions and governments and mutual funds and hedge funds, buying it like they're buying gold. And I said this before, but now we're starting to hear about it on television. We're starting to see it on CNBC, MSNBC. All the pundits are starting to talk about it. And where are we going from here? We're seeing London Brent crude already up to 72.57. We're seeing West Texas Intermediate 74.94. That's up $8, $9, $10 a barrel just in the last week or two. And that's where it's coming from. But why? It's one thing to make money. Now the stock market, we're seeing this, look, 9,995 on the New York Stock Exchange, on the Dow. Is that important? Is it a psychological barrier? Can it go higher? Is it overpriced? A, it's overpriced. B, yes, it can go higher. It's speculation. It's not based upon fundamentals. But you've got, why is it happening? I was asked this today. Because money managers have to participate in a rise or they lose their jobs. If you're managing a mutual fund and you're all in cash and you don't get involved in this, guess what? You lose your job. They're not going to do that, especially come the end of a quarter. They've got to show themselves invested. But what they're also doing, these trillions of dollars on the sideline, is they're coming into physical commodities. Gold and oil are the two primary ones. Now, one, I'm going to take a look here, zoom in on this. This is a graph showing the drop in purchasing power from 1970 to now. That's about when we went off the gold standard. How's that for a coincidence? But that's an 86% drop in purchasing power. 86%. That's $1 becoming worth 14 cents. That's like your $10,000 becoming worth $1,600 over that time period. Now, if you're recently retired, say you're 60 years old or 65 years old, you're looking at 25, 30 years more of life, and you're going to lose 85%, if you're lucky, of your buying power over that time, and you're only making a couple of points in the bank. Yeah, I'd be worried too. That's why gold makes so much sense. It's a must-be. It's an insurance policy. But can we take a look at a couple other charts? This is gold since 2000. This is silver. This is platinum. These are all the investment indices. But more important, right down here, this is the money supply. Same time period. But look here. You see this recent jump? 8 to 16 trillion. Whoa, that's a doubling of the money supply in the last 7 or 8 years. Now this is going to trigger hyperinflation. It's going to come in this time period. We're going to see this chart really take a drop. Now, hedge funds, mutual funds, for the first time, are making these investments. There are trillions of dollars in cash on the sidelines that are propelling these investments to trigger points. Trigger points are where the big spurt in the price is going to come in. It's going to get to that point and then kaboom, it's going to break through and run. At that point, we'll probably be selling out. That's what we look for. We look for that spurt, that speculation spurt. And I may have been wrong. It may be coming sooner than I expected. With all the things that are going on right now, it might be coming sooner. But the risks right now, ladies and gentlemen, are not being involved in these investments and watching them fluctuate or maybe pull back a little bit after you go in. The risk is not being involved. To do that, well, you've got the contact information. I'm not going to go into that. However, I will say, listen to the radio show. I hope you enjoy it. I hope you enjoy our clips. And thank you all very much. Those of you that have called in, that have made comments, etc., thank you very much. Those of you who have come on board with us, very, very good job. Hope you enjoyed this program. Have an absolutely fantastic day. And until we next speak, have a wonderful, wonderful day. And may God bless you all.